A retired couple in Minnesota sat down with their accountant last spring and found out they had been paying $6,800 a year in state income tax on a pension they spent 30 years building. Same pension, same income, different state, and that number drops to zero, not because of a loophole, not because of a complicated strategy, because of a line in the state tax code that nobody bothered to show them when they chose where to retire. That couple is not unusual. They made the same mistake most retirees make. They picked a state based on weather, family, familiarity, and they never ran the tax numbers. Over 20 years of retirement, that $6,800 a year becomes $136,000. Gone. On income they already saved. On money they already paid federal taxes on. Today, I'm going to show you exactly which states are taking the most from retirees in 2026, which 5 are protecting the most, and what most of these rankings get completely wrong. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making any decisions about your specific situation. My name is Jake. Every week I break down the tax rules, the retirement traps, and the strategies that protect your wealth from the things nobody else is explaining clearly. If that sounds like something you need, hit subscribe right now and turn on notifications so you never miss a video. Let me start with the 3 states costing retirees the most. And the first one is going to surprise people. Number 3 on the worst list, Vermont. Vermont is a beautiful state, excellent quality of life, and one of the most aggressive tax codes for retirees in the country. Vermont starts taxing your Social Security benefits the moment your income crosses $50,000 as a single filer. That is the lowest threshold in the entire country. Your pension gets taxed at rates up to 8.75%. Your 401k withdrawals, same rate. Your IRA distributions, same rate. And Vermont carries a flat 16% estate tax waiting on the back end. Put a number on it. A retiree drawing $50,000 from a pension and $25,000 in Social Security is paying $3,000 to $4,000 a year in state income tax on retirement income, in a state that also carries some of the highest property taxes in the Northeast. Most people who retire in Vermont do it for the lifestyle. The tax bill never enters the conversation until it is already too late to matter. Number 2 on the worst list, Minnesota. Minnesota has excellent hospitals. The Mayo Clinic is there. That is a real and legitimate advantage for retirees thinking about healthcare access over a 20-year horizon. But here is what that does not fix. Minnesota taxes pension income, 401k withdrawals, and IRA distributions at up to 9.85%. It taxes Social Security for anyone earning above roughly $84,000. And it carries an estate tax that begins at $3 million. A retiree with a $65,000 pension and $25,000 in Social Security is writing a check to Minnesota for roughly $4,500 a year. That is $375 a month, every month, for the rest of retirement. On money that a handful of other states would not touch at all, number 1 worst state for retirement taxes, California. California exempts your Social Security. That is worth acknowledging. Everything else, your pension, your 401k, your IRA, your annuity income, gets taxed at rates that reach 3% at the top bracket. No exclusion, no special treatment for retirees, no deduction for the decades you spent building what you built. A retiree with $60,000 in pension income and $30,000 in IRA withdrawals is handing California roughly $5,400 a year in state income tax, on top of a median home price near $900,000, on top of wildfire insurance premiums that have doubled in 5 years. Run the 20-year number. That is $108,000 in state income tax alone. On income that already cleared the IRS. On savings that took a lifetime to accumulate. That is not a tax bill. That is a college education. That is a property. That is compounding inside a Roth account for 20 years. Gone. Now here is where most of these videos go wrong. The obvious conclusion at this point is simple. Pick a state with no income tax. Florida, Texas, Nevada, Tennessee. Pack up and move. That logic is not wrong. It is incomplete. States that collect no income tax still collect revenue. They get it through property taxes, sales taxes, insurance markets, and costs that never appear on any tax-free state article. I have seen retirees make the move on the income tax headline and end up spending more, not less. So when I built this ranking, I looked at 5 categories. Retirement income tax treatment, property taxes and housing costs, healthcare access, cost of living, and the hidden costs most rankings quietly ignore. Here are the 5 states that held up across all of them. Number 5, Iowa. Iowa recently overhauled its entire tax structure. Starting at age 55, every dollar of retirement income is exempt from state tax. Social Security, pension, 401k, IRA. 0, all of it. They eliminated their inheritance tax in 2025. The flat income tax rate is dropping to 3. 9%, but retirees living on retirement income will not see that rate applied to any of it. Iowa has real weaknesses: cold winters, limited metro amenities outside Des Moines, property taxes around 1% that are not negligible. Healthcare access outside the major cities is thin. But on pure retirement income protection, Iowa is doing something most people have not noticed yet. If the winters are manageable for you, the tax math is difficult to argue with. Number 4, Nevada. No state income tax, no estate tax, no inheritance tax, property taxes that rank third lowest in the country at 0, 47%. A retiree with a $400,000 home in the Las Vegas area is paying roughly $280 a year in property taxes. That is the entire bill. The trade-off is healthcare. Nevada ranks 35th nationally. About 188 physicians per 100,000 residents. Compare that to Pennsylvania at 280 per 100,000. For a healthy retiree who does not need regular specialist access, Nevada is a clean, simple, low-cost structure. For someone planning a 20-year horizon with real medical complexity, that gap is not cosmetic. Number 3, and this is the one most people completely miss. Pennsylvania, I know, a state with an income tax. Most people see that and they stop reading. That is exactly the mistake. Pennsylvania exempts 100% of Social Security from state tax, 100% of pension income, public or private, 100% of 401k withdrawals, 100% of IRA distributions, no income cap, no phase out, no fine print. The flat 3.07% rate applies to earned income, investment income, and capital gains. If you are retired and living on Social Security, a pension, 401k withdrawals, and IRA distributions, your Pennsylvania state income tax bill is functionally 0. Let me put a number on it. That same retiree in California paying $5,400 in state income tax on pension and Social Security pays 0 on both in Pennsylvania. If they have $30,000 in investment income, they pay 3.07% on that, $921. Total state income tax bill, $921 against California's $5,400. That is $4,479 back in their pocket every single year. Here's why Pennsylvania lands at 3 instead of 1. Property taxes. In many parts of the state, you are looking at $6,000 to $9,000 a year on a home most retirees are actually buying. And Pennsylvania carries a 4.5% inheritance tax on assets passed to children, 12% to siblings. On a $1 million estate, that is $45,000 your children do not receive. Those are real numbers, and I will not soften them. But for a retiree coming out of the Northeast who wants 0 tax on retirement income and wants world-class healthcare within reach, Pennsylvania deserves a serious look that most people never give it because they stopped reading at the words income tax. Number 2, Tennessee. No state income tax, no estate tax, no inheritance tax, property taxes averaging 0.56%. Vanderbilt and a strong hospital network in Nashville. Cost of living running about 7% below the national average. Tennessee earns this ranking cleanly. One thing most people overlook, Tennessee carries the highest combined sales tax rate in the country at roughly 9.6%. Groceries are taxed at 4%. A retiree spending $50,000 a year on taxable goods is paying close to $4,800 in sales tax. That is $400 a month that does not appear on any income tax-free state comparison. Pennsylvania exempts groceries and clothing from sales tax entirely. That difference compounds across a 20-year retirement in ways that most rankings do not account for. Tennessee is still excellent, but the sales tax is a real cost and it deserves to be in the conversation. Number 1, Florida. Florida earned this. No state income tax, written into the state constitution. No estate tax, no inheritance tax. The largest retiree infrastructure in the country. The Homestead exemption caps your property tax assessment increase at 3% annually, regardless of how much home values rise. Across the full scorecard, Florida wins. But I'm not going to give you a number 1 ranking without giving you the full picture. Homeowners insurance in Florida now averages over $7,000 a year, highest in the nation. In coastal counties, you are looking at $10,000 or more, plus separate flood insurance on top of that. Hurricane risk is real, and it is priced into every single policy in the state. A retiree who saves $3,000 a year in state income tax and then pays $500-$600 more in insurance than they would in the mid-Atlantic did not come out ahead. They went backwards. Florida still works. It works very well for a lot of people. Inland areas with lower insurance exposure and strong medical access are genuinely excellent. But you have to run the full numbers, not just the income tax line. The full numbers. Before I give you the final summary, here is what is different this year that most of these rankings are not accounting for. The One Big Beautiful Bill created a new $6,000 senior bonus deduction at the federal level. If you're 65 or older with modified adjusted gross income under $75,000 as a single filer or $150,000 married filing jointly, you receive an additional $6,000 deduction on top of your standard deduction. $12,000 for married couples where both spouses qualify. This is brand new. It reduces your federal taxable income regardless of which state you live in, but it changes the comparative math between states because it shifts the base from which everything else is calculated. The SALT deduction cap also increased from $10,000 to $4,400. If you're in a high property tax state and you switched to the standard deduction in 2017 and never revisited it, you need to run the numbers again. The math may have flipped. And with retirement accounts down in the current market, Roth conversions right now are more attractive than they have been in years. You pay tax on a lower dollar amount, and every dollar of recovery happens inside the Roth tax-free. The state you live in determines how much that conversion costs you. A $50,000 Roth conversion in California carries an additional $6,750 in state tax. The same conversion in Pennsylvania costs you nothing. Because IRA distributions are exempt, there's no single best state for every retiree. Florida wins if zero income tax and warm weather are the priority and you can manage the insurance exposure. Tennessee wins if low property taxes and cost of living matter most, and the sales tax is something you can plan around. Nevada wins on simplicity and low housing costs if healthcare access is not a pressing concern. Iowa is the one most people have not looked at yet, and Pennsylvania is the one most people dismissed before they ever read the details. The right state is the one that matches your specific numbers. Your pension, your Social Security, your IRA balance, your investment income, your home value, your healthcare situation. All of it on one page compared side by side. Not the headline, the numbers. Now you know which states protect retirement income and which ones take a significant cut. But picking the right state is only part of it. Once you are there, you still need to make sure you're claiming every deduction you are entitled to. The $6,000 senior bonus deduction I mentioned is brand new and most tax software is not flagging it automatically. If you missed it on your 2025 return, you can still amend within 3 years. Watch my next video where I break down the 7 IRS changes in 2026 that are costing retirees thousands. Every deduction, every deadline, all of it. This is Jake. If this video helped you, hit the like button right now. 1 second, and it helps this reach more retirees who need to see the actual numbers. If you are not subscribed, hit subscribe and turn on the bell. The videos coming next could save you real money. If you know someone deciding where to retire, send them this today. The difference between the right state and the wrong one is not small. Over 20 years, it can be 6 figures. Drop a comment. What state are you in? What are you actually paying in state taxes on your retirement income? I read everyone, and the most common situations become future videos. I will see you in the next one.